Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering the best dividend stocks going ex-dividend November 26th through the 30th, 2018. So if you're looking to add some new dividend stocks to your portfolio, you've came to the right place. So if you are brand new to my channel, I do make stock market, personal finance, real estate investment videos every single week, so consider subscribing, hit that notification bell, and if you want to get emailed every time I release a new article, sign up for my blog, just head over here, type in your email address, and subscribe. Now, in this video, we're going to be covering 5 dividend stocks going ex-dividend next week, but I had a bunch of them actually go through my screening process. These are just the 5 that won because they have been growing their dividend out the longest. So if you haven't checked out my Facebook page, it'll be in the description below. This post was posted out on Monday, and then I had to kind of share that information over there on my Facebook page. Now, the 5 stocks we're going to be covering today are ticker symbol CFR. This is the Frost Bankers. We have ticker symbol J&J. This is, of course, Johnson & Johnson, ticker symbol MXIM. This is the Maximum Integrated Products. We have ticker symbol O. This is Realty Income. And we have ticker symbol SWK. This is Stanley Black & Decker. Now, all of these stocks, including the ones here that I posted over on Facebook, were screened, with the following method. So all of them had starting yields greater than 1.5, meaning that if you invest $100, you're going to be making $1.50 or more in just straight dividends, getting paid back to you and reinvested into your account. Plus, you're going to get that appreciation or equity change throughout the year. All of these stocks have grown their revenue, net income, free cash flow positive over the last 5 and 10 years. Some of their net income looks a little bit wacky. That is because of tax reform. They were able to write off a little bit more. So it looks like they dropped their net income, but they really didn't. They just wrote off a little bit more. Their forward price to earnings is expected to be less, meaning that their next year's earnings per share is expected to grow and decrease their PE because they're growing by a nice margin, and their price in comparison to their earnings, it's fluctuated there, causing their PE to go down and their earnings per share to go up. They've grown their dividend for at least 5 years. All of these, the minimum here is 8 years. All of them, Realty Income, Frost Bankers, Stanley Black & Decker, Johnson & Johnson. You can see over 20 years and over 50 years here at the top. Now, in this article, we're going to be covering the dividend dates, the price comparison to the yield, the PE comparison to the industry and the S&P 500, the payout ratios, the dividend history, how much they've grown their dividend per year over the last 10 years, and a few other statistics as well. So if you haven't got started in your investment journey, I have links here to M1 Finance and Robinhood. I also have a couple other recommended brokers, but these ones offer free environments where you can get free commissions. M1 Finance allows you to open up retirement accounts. I highly suggest opening up a self-directed Roth IRA, meaning that you can just invest for free. There's no fees, there's no commissions. It's partial shares, so if you want to buy $100 of Amazon, that's all you got to invest, you can do that. If you want to open up a retirement account, it's $500, but all those links are there in the article. I've created 2 apps called the Simple Dividend Calculator and the Simple Retirement Calculator. Basically, one for the dividend investors, finding out how much you would get if you invested per week, per month, per year, over X amount of years, and finding out what your own retirement calculator is. Putting your current age, what age you want to retire, how much you want to have, being able to withdraw in your retirement age, and that calculator does it for you. So check them out. If you have anything, questions going over these specific apps, let me know in the comment section below or just write me. And all of these stocks are ordered by ex-dividend going November 26th through the 30th, 2018. So while they may have a number 1 next to them, that's not that they're recommended number 1 over any other stock. This is just the order that they're going ex-dividend in. So number 1, we have ticker symbol J&J. This is Johnson & Johnson. It's a holding company that researches, develops, and manufactures a diversified range of products in the healthcare field. Here you can see their segments include consumer, pharmaceutical, and medical devices and diagnostics. Their ex-dividend is next Monday on the 26th of November. If you wanted to buy this one for the ex-dividend date, because the ex-dividend is on Monday, you would actually have to buy it this Friday or prior, and then you would receive that payout on the 11th of December. Here we can see that their price over the last 10 years is up 143%. So I like to show these sort of metrics over 10 years because you can take their price, their revenue, their free cash flow, their net income, divide it by 10, and that's going to give you your average increase per year. So their price is up 143%. You divide it by 10, that's a 14.3% average increase per year over the last 10 years. You can see that between 1998 and 2013, they had mainly traded sideways, but as of 2013, along with many other stocks, they broke out and have been hitting some new 52-week highs, as Johnson & Johnson has just recently done. Now, in the red, free cash flow at 5.3% on average per year. In the orange, their revenue is up about 2.7% on average per year, and their net income up is down. Currently, this is just because they were able to write off so many different deductibles during the tax reform going into 2018 that it does show them at a negative, but this will get corrected going into possibly 2019. You should see this either dip or change back to that reasonable level. Here, I like to show off the 1-year graph. So currently, Johnson & Johnson pays out 90 cents per share each quarter. They're currently priced at $148, which is their highest point that they've ever been to. This is all-time highs. Their 200-day moving average is at $131.06. Their current PE is at 2.44 or 2.35, depending on the day. That price changes, that the dividend percentage there changes. Their current PE ratio is 290.48, but that's actually incorrect. If you take their earnings and their current price, you get their current PE ratio at that 18.14, 18.15 range. Their price to book is at a 6.14, price to sales is at a 4.97. So when charted, it does show the current stock does have a price over the yield. You can see the price is way up here, trading well above that 200-day moving average and the average yield for the year, meaning that it could be overvalued at this time. The stock is trading below the industry average of 28.8 and below the S&P 500 average currently of 21.97. It is sitting well below the 60% payout ratio at a 44.2. It's had dividend growth for the past 55 years. That means that for the last 55 years, Johnson & Johnson has increased their dividend year over year over year for the past 55 years. Their price to book value is 6.14, which is above that 3.0 value, where those asset-based companies would be considered a deal. Price to sales is at a 4.97, which this is a sales driven company here, so it is trading above that 3.0 value, where sales and service-based companies would be considered a deal. So the current stock here, PE 18.14, industry 28.8, S&P 21.97. We already covered much of this. The only thing here is their 90 cents per share each quarter is paid out. If you multiply that by 4, that's going to get your annualized payout of $3.60 per share for the entire year. And they've grown their dividend for the last 55 years. Over the last 10 years, they've grown their dividend an average of 9.5% just year over year. So if you go by the rule of 72 and you take 72 by 9, you would have doubled your dividends within that by the 8th year. 8 by 9 is 72. So by the 8th year, if you had invested 8 years ago, right now, your initial investment, you'd be receiving double the dividends that you had back 8 years ago. And they've grown their dividends since back in 1963. Number 2, we have ticker symbol MXIM. This is the Maximum Integrated Products. They engage in the design, development, manufacture, and marketing of various linear and mixed signal integrated circuits, analog circuits worldwide. It offers a range of high-frequency design processes and capabilities that could be used in custom designs. So their ex-dividend is next Wednesday, November 28th, 2018. You'd have to buy them on Tuesday or prior, hold them until Wednesday. Your payout would be on the 13th of December. Here, again, 10-year graph. You take their price divided by 10. That gives you your price per year for the last 10 years is at an increase of 29.9%. In the green, net income up 22% on the average per year. In the red, their free cash flow up 10.5% and their revenue up 3.3%. So very nice looking company here as far as financials go, and price, beating out the S&P 500 average over the last 10 years. So this one almost 300% positive over just the last 10 years, and this one pays out a pretty good yield here. So moving down here to their 1-year graph. This company recently raised their dividend here slightly, after May they announced a dividend increase. So they raised their dividend now to 46 cents per share each quarter. Their 200-day moving average is $58.29. They're currently trading at $51.98. You can see here that they bounced right around that $47, $48 point. Now coming off those lows, their current yield, because of their new increase there back in June, from a 3.19, because they increased it from about 41 cents and some change to now 46. That puts them at a new dividend yield of 3.54%, which doesn't quite put them, it puts them, up here in this range as far as yield goes. So current PE 28.88, forward PE 18.88, price to book 7.53, price to sales 5.79. So when charted, it does show this current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is above the industry average of 19.2. It is also above the S&P 500 average of 21.97. Below, it is sitting below 60% payout ratio, sitting at a 59.4. So it's barely there on that ratio that I like to look at. It's grown their dividend for the past 8 years since 2010. It did freeze their dividend between 2008 and 2010. Their price to book value here 7.53, which is above that 3.0 value where asset-based companies would be considered a deal. The price to sales is at a 5.79, which is also above the 3.0 rating where sales and service-based companies would be considered a deal. If you multiplied 46 by 4, you would get that annualized payout of $1.84 per share. They've grown their dividend for the past 10 years at an average increase there of 13%. So that is ticker symbol MXIM. This is kind of an interesting one here. Kind of looking into it, I still probably, if I had to look into it more, kind of what I gathered off of it, I still didn't gather a whole lot of what. Are they more service? Are they more sales? It does look like a sales and service driven company versus assets. So while it is pulling back, it could be slightly still high just due to the industry and the S&P. You can see it's trading at a very high PE and price to book and price to sales ratios. Number 3, we have ticker symbol SWK. They provide power and hand tools, mechanical access solutions, and electronic security and monitoring systems primarily in the United States, Europe, Latin America, and Canada. They do a whole bunch of do-it-yourself segments, including the professional corded, cordless electronic power tools and equipment, and many other products there. Their ex-dividend date is on the 29th of November, which is next Thursday. You would have to buy this stock on Wednesday or prior. Hold it until Thursday, then you would get paid out on the 18th of December. Here you can see their price difference over the last 10 years, up 31.4% on average. They have came down hard. Going into 2018, their price or their net income up 22% per year on average. Their revenue up 20.7% on average, and in the red we have free cash flow up 16.9% on average. So very good financials as far as a product company. This is a consumer company there. Stanley Black & Decker, just taking a look at their 1 year. Let's go ahead and move down slightly. They currently pay out 66 cents per share each quarter. Their 200-day moving average is $142.92. They're currently trading at $126.86. They did fall down, nearly down to about $110. Now they are bouncing off those lows. This is, this quick disclaimer, I am holding ticker symbol SWK. This little segment here is, I believe it's mainly because of the Sears sell-off. Sears announcing bankruptcy. They owe Stanley Black & Decker roughly $9 million. So during this process that Stanley Black & Decker knew that they're not going to get paid back their money, I think a lot of investors saw this as a negative and, quickly sold out of this position. So they are slightly recovering off those lows. So 200-day moving average, $142.92. Current dividend yield, about 2.01, 2.08. They just increased it back in June from around 62 cents and some change to now 66 cents. Their current PE, 19.49. Their forward PE, 15.59. Price to book, 2.6. Price to sales, 1.42. So when charted, does show the current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 19.8 and below the S&P 500 average of 21.97. It does have a payout ratio below 60%. It has a payout ratio currently of 31.6. It's grown their dividend for the past 50 years. Their price to book ratio is 2.61, which is below that 3.0 value where asset-based companies would be considered a deal. Its price to sales is 1.42, which is below 3.0 where sales and service-based companies would be considered a deal. So here, the only information we didn't cover, we multiply 66 by 4. We're going to get $2.64 per share each year. They've grown their dividend for the past 50 years. Over the last 10 years, they've grown their dividend at an average of 10.6%. So if you had invested in them 7 years ago, you would roughly be doubling your dividend going into 2019. And they've been paying out and growing a dividend since back in 1968. Number 4, we have ticker symbol CFR. Cullen/Frost Bankers provides banking and financial services primarily in Texas. They serve energy, manufacturing services, construction, retail, telecommunications, healthcare, military, transportation industries. So their ex-dividend is next Thursday. Again, you'd have to buy the stock on Wednesday or prior, hold it until Thursday. You would then receive that dividend payout on the 14th of December. Here we can see their 10-year chart. Taking a look here at the red, that's their free cash flow up 24% on average per year. In the green, their net income up 11% on average per year. In the blue, their price up 9.4% on average per year. You can see they had a bit of a dip between 2015 and 2017. They began to grow. And in the orange, revenue up 5.6% on average per year. So again, double digits, almost double digits there as far as price, and revenue up, not so much there, but that's completely fine. So they currently pay out 67 cents per share, raising their dividend back in March from about 56 cents per share to now 67 cents per share. So that was a very nice rise up there. Their 200-day moving average is at $108.87. Their current price at $101.02. You can see they bounce off those lows back in January. They were also trading above, or right at that $90 point. They hit that $90 point again, hit that support level, bounced off, now trading at $101.02. Their current dividend is 2.65. Looks like they may have raised it back in March, so this could be slightly, it could be about 2.45, could be 2.65. It just depends on the price. So price of the day, and you take the price per share, divide it by the current price of the day, and it's going to give you your dividend yield when you multiply it by 100. So PE ratio 15.31 currently, forward PE 14.81, price to sales 5.0, price to book 2.0. So when charted, it does show the current stock does have a price underneath the yield, which may indicate it could be undervalued at this time. The stock is above the industry average of 13.6 and below the S&P 500 PE average of 21.97. So here it's a financial. Below 60% payout ratio, it has a payout ratio of 39.6%, and it's grown their dividend for the past 25 years. So this is an interesting one. Financials, you don't see a lot of financials. You saw Goldman Sachs, JP Morgan, Citibank, and many others cut their dividend or just completely freeze it, lock it out, cut it, stop it. Back during the financial crash, this one just continued to raise it since 1993. Price to book here, 2.04, which is below that 3.0 value where asset-based companies would be considered a deal. Price to sales at a 5.07, which is above that 3.0 value where sales and service-based companies would be considered a deal. This is a financial institution, so I like to see a 1.3 to 1.7 ratio, but price to book ratio here at a 2 could be a little high, but they did bounce here. You can see them bouncing off their lows. So if we multiply their current dividend by 4, that's going to give you $2.68 per share each year. They've grown their dividend on average over the last 10 years at a 5.95% increase, and they've been growing their dividend for the past 25 years since 1993. And number 5, the last one here, we have ticker symbol O. This is Realty Income. This is a lot of people's favorite REIT here. This is a real estate investment trust, meaning that it does get taxed a little bit differently unless it's held inside your Roth IRA. If it's held inside your Roth IRA, you don't have to pay taxes. You don't have to tell anybody that you're getting paid out from a REIT, that's an unqualified dividend. So this is known as the monthly dividend company, trademark there. It is within the S&P 500. It is dedicated to providing shareholders with dependable monthly income. These monthly dividends are supported by the cash flow from the company's property portfolio. Realty Income is an in-house acquisition, portfolio management, asset management, credit research, real estate research, legal, finance, accounting, information technology, and capital marketing capabilities. So it has a lot of branches and segments, and you know, it's interesting. It does a lot more than just real estate. It also has other segments inside of it. Though their ex-dividend is on Friday, the 30th of November. You'd have to buy this one on Thursday or prior to be able to hold it until Friday. Then you would get paid out the dividend on the 28th of December, where it would basically be going ex-dividend again. This is a monthly paying stock, so every single month they have an ex-dividend. So they have an ex-dividend at the end of November, they have an ex-dividend at the end of December, and then you'll always get paid out at the end of the month. So you have the ex-dividend on the end of the month, you have the next payment on the end of the month with that ex-dividend. So here we take a look at the price, up 253% over the last 10 years, or 25% on average per year. In the orange here, we have their revenue up 29.8% on average per year, or nearly 300% over the last 10 years. In the red, we have their free cash flow up 27.6% on average per year, or 276% on average per year. In the green, we have their net income up 157% over the last 10 years, or 15.7% over the last 10 years. So very strong financials here. Everything here is in the triple digits, 15% or more. Taking a look here at their 1 year, we have them currently trading. They are breaking out. This is at one of their highest points here, $64. Currently at, this is, I get notifications every single day from my app, my Robinhood app here, that they're breaking out. They're 52-week high again and again. So $64 currently. They currently pay out 22 cents per share each month. So they pay out every single month 22 cents per share for 12 months. Their 200-day moving average is $54.56. Their current dividend yield is 4.14 or 4.10, just depending on the day. You can see if you bought this back during that dip in February, March, you would have locked in nearly a 5% yield. Their current PE is around a 54.34, forward PE 50.2, price to sales 14.12, price to book is 2.46. So when charted, it does show the current stock does have a price over that yield, which may indicate it could be overvalued at this time. The stock is trading above the industry average of 17.1, above the S&P 500 average of 21.97. Does have a higher payout ratio of 83.2. This is completely normal for REITs. They have to pay out at least 90% of their earnings and eligible in order for them to be taxed, be able to write off and not show as much of that income there. So they've grown their dividend for the past 22 years, since 1996. So they pay out dividends and grow their dividends through the 2008 crash. Their price to book here, they're an asset-based company, so their current price to book 2.46, which is below that 3.0 value where asset-based companies would be considered a deal. Their price to sales is at a 14.12, which is above 3.0 where sales and service-based companies would be considered a deal. Their stock here, PE, we already covered this. So the only thing here, multiply their current dividend payout per month by 12, and you're going to get $2.65 per share each year. They've grown their dividend for the past 10 years at an average increase there of 5.62%. And they've grown their dividend since 1996. So that is that's the 5 stocks we're going to be covering in today's article. So I hope you guys did enjoy the article. If you did like the video, if you would like to just go over to my website, check out the article. Link will be in the description below and also in the comment section. If you have any friends or Facebook groups, anybody that would like to look at specific dividend stocks to check out, share this article with them. And again, if you haven't started your investment journey, you haven't started your self-directed Roth IRA, I highly suggest you guys do go out there, start your Roth IRA. So, quick disclaimer, I'm not a financial advisor, tax professional. The information provided is my opinion for entertainment and fun. This is just me as a financial investor trying to help others make their money work for them. And as another disclaimer, I am a shareholder of ticker symbol SWK. I've held it now for maybe a couple months, 3-4 months now, and will continue to hold it. And if I had to pick one of these stocks in addition to my Stanley Black & Decker to continue buying and holding, while I do like O, I don't find it at a good buying opportunity right now. This has been blowing up. You can see from back in February, March. So if I were looking to add a value play, I would probably add another financial into my portfolio. I'm not sure. I don't know a whole lot. Johnson & Johnson's already also trading towards high. So at this time, I'd probably cut out Johnson & Johnson. I wouldn't invest in O just because they're so high. I may look into what, a little bit more of what MXIM does, because straight off what, the description here, didn't give me a whole lot to go with here. So my other one here probably would take a look at financial. So ticker symbol CFR by default, just because it is trading at nearly its lows here. It is slightly coming off those lows. It could go back down, but for the most part, financials having kind of hammered recently. So we shall see. So let me know in the comment section below of these 5 stocks. Again, we had ticker symbol J&J. We had ticker symbol MXIM. We had ticker symbol SWK. We had ticker symbol CFR. And we had ticker symbol O. Which of these companies would you pick? If you had to pick one to add to your portfolio, let me know in the comment section below. And thank you all for tuning in. If you did like the video, give it a thumbs up button below. And I will see you next week. Have a great day. Bye.